Thank you for visiting Financial Insider, your go-to source for information on personal finance. In this video, we'll discuss the many causes of your investment's potential failure and offer real-world examples to help you comprehend these frequent causes. It's not always simple to invest, but it can be a terrific method to increase your money. The performance of many people's investments falls short of their expectations. Your investments may be failing for a variety of reasons, and in this video, we'll look more closely at some of the most typical ones and give actual world examples. One of the most common reasons why investments fail is lack of diversification. Diversification is the practice of spreading your money across different types of investments, such as stocks, bonds, and real estate. For example, if you only invested all of your money in the technology sector and the sector faced a downturn, all of your investments would be affected. However, if you had diversified your portfolio by also investing in the real estate and healthcare sectors, the impact of the downturn in the technology sector would be lessened. There are a few legitimate causes for your investments to lose money. Lack of a proper asset allocation plan. This suggests that, given your risk tolerance and financial objectives, your portfolio's mix of stocks, bonds, and cash is out of balance. For instance, it can make sense to have a higher percentage of equities in your portfolio if you have a high risk tolerance and are willing to take on more risk. However, it might make sense to include a bigger amount of bonds in your portfolio if you have a low risk tolerance and desire more stability. Not keeping up with market changes. The market is always changing, therefore it's critical to stay current. For instance, if you invested in a sector that is declining and failed to recognize it and make adjustments to your portfolio, such as the oil and gas sector, your investments in that area might not do well. Not routinely checking your portfolio. It's critical to regularly check on your portfolio to make sure it still reflects your financial objectives and risk tolerance. For instance, it can be necessary to sell a stock if you initially bought it with the idea of owning it for a long time, but circumstances change and the stock no longer fits your objectives or risk tolerance. Not having a good exit strategy. To maximize profits and reduce losses, you should have a clear exit strategy for your investments. It might be a smart idea to sell the stock and reinvest the money in a more promising investment. For instance, if you invested in a stock with the aim of owning it for the long term, but the stock's performance starts to deteriorate. Emotional investing is another factor that could lead investments to lose money. Many investors base their selections more on their feelings than on logic. An investor, for instance, would buy a stock without taking the company's long-term prospects into account because they heard a rumor that it was about to increase. Or they might sell a stock because it has lost value without taking the company's future prospects into account. This kind of emotional investing might result in sloppy judgment and ultimately investment losses. Unrealistic expectations are another frequent factor in unsuccessful investing endeavors. Unaware of the risks and the long-term nature of investment, many investors hope to see high profits overnight. An investor might, for instance, invest their entire portfolio in a high-risk startup in the hopes of seeing a profit within a few months. But if a firm ever becomes profitable, it typically takes years, and the investor could end up being out their entire investment. Lack of a clear investment strategy is yet another frequent cause of investing failure. Without a defined investment strategy, it's simple to get carried away by the excitement around the most recent investment opportunity and take rash actions. Without having a thorough understanding of the underlying technology or the current market conditions, an investor can, for instance, invest their entire portfolio in the newest, hottest cryptocurrency. You can stay on track with your objectives and make wise judgments by having a clear plan of action. It's crucial to keep in mind that investing does not guarantee returns, so you should be aware of the hazards. It's also critical to realize that short-term market volatility are typical and that actual growth can take months to manifest. In conclusion, the reasons why your investments may be failing can vary, but it's important to understand that diversification, research, emotional investing, unrealistic expectations, and lack of a clear strategy are common factors that can lead to poor performance. By understanding these common reasons, and using real-life examples, it's easier to avoid these pitfalls and make informed decisions about your investments. Thanks for watching. We hope you found this video helpful. Be sure to subscribe to our channel for more personal finance tips and tricks. Don't forget to leave a comment below and let us know.